We have a bad Fed chairman, really bad. If he would lower the rates, and I tried being nice to the guy, it doesn't help. He's like a knucklehead. No, he's a knucklehead.
When the president says rates should be cut and the Fed says we're not there yet, who's actually in charge? The answer could determine where markets go next. The Fed's 2% inflation target is still the anchor. Fiscal policy, driven by the president and Congress, focuses on spending and taxation. Monetary policy, rates, liquidity, and the balance sheet is the Fed's domain. These levers often pull in opposite directions. Markets are now assigning a 92% probability to a September rate cut, according to CME FedWatch data. Only 8% of traders think the Fed will hold rates at the current 4.25 to 4.5%. But here's the tension. High market confidence doesn't guarantee a cut. The latest data shows headline CPI in July holding at 2.7% year over year, with monthly inflation at 0.2%. Core CPI rose to 3.1% from 2.9%, with a monthly gain of 0.3%, still running above the Fed's comfort zone. The Fed's preferred measure, the PCE price index, tells a similar story. In June, headline PCE climbed 2.6% year over year and 0.3% month over month. Core PCE stayed at 2.8% year over year, with monthly momentum also at 0.3%. Underlying inflation pressures aren't cooling as quickly as policymakers want. So, is the president's push for cuts justified, or is the Fed right to be cautious? To answer that, we look at whether the economy is at its optimal output, where resources are fully used without sparking inflation. Right now, the U.S. output gap is over 13% above potential GDP, a sign the economy is running hot. But capacity utilization tells a different story. Total industry is at 77.6%, still below its long-term average of 80%. Manufacturing is at 76.9%, about 1.3 points under its historical norm. That means demand is strong enough to strain the system, but there's still slack in industrial production. And that mix makes the rate cut debate even trickier. History warns us on both sides. In the late 1960s and 1970s, the Fed cut too soon, inflation reignited, and the economy slid into stagflation. In the early 1980s and again in 2006, the Fed held rates high for too long, triggering recessions. This is why critics say the Fed is behind the curve. If they move too late, damage is already done. Move too soon, and they lose control of inflation. The Fed's reaction function, their playbook, weighs inflation data, employment reports, and financial stability risks. They're not reacting to political speeches, they're reacting to hard numbers. For investors, understanding that framework lets you anticipate moves before the headlines hit, whether September brings a cut or not. If you found this breakdown valuable, like, subscribe, and share. Staying ahead of the Fed starts with understanding the playbook.